Welcome back to our series dealing with markup and margin. And in our last video, what we would have looked at, the fact that we would have been able to calculate what our receipts from our debtors were, or our credit customers. This is 118,600. We would have calculated our credit purchases, which were $107,900. And we were also able to calculate our payments to our creditors of $103,000. And we were able to enter the receipts from our customers into our bank account and payments to our creditors into the bank account. And then that left one missing figure. And we were able then to use the bank account to find out what our drawings figure was, which is $5,800. Subsequently to that, we then recognized that in our step 4, we didn't have any accruals or prepayments to make adjustments for. So we didn't make any adjustments for accruals and prepayments. But then we went on to step 5 and we would have calculated, we didn't have any allowance for doubtful debts to calculate, but we calculated a depreciation for our fixed assets of $8,000 at 10%, which gave us $800. So what are we going to be doing in this video today? What we will be doing now is that we would then take a look at our, income statement, because we have enough information that we can now prepare our income statement. So I need probably about just 3 rows for that. So we're going to do our income statement. Three columns. So this you header. Remember, you always put the name of the business. So a James Bond. Type of statement, income statement. For the which period? For the year ended 31st of March 1985. Put in our dollar signs. And then our income statement will start with our sales. And we know our sales figure, we calculated it. Our sales were $131,000. So we're going to put in our sales, $131,000. We don't have any sales returns, so you don't need to make adjustments for any sales returns because we don't have any in this question. So then we're going to say less our cost of sales or cost of goods sold, whichever term you prefer to use. And how do we calculate our cost of sales? We take our opening, the basic formula is to take your opening inventory, add your purchases, and subtract your closing inventory. However, if you have like purchases, returns, carriage outward, carriage inwards, if you have purchases, return, carriage inwards, or any duties on those purchases, you have to make an adjustment for your purchases before subtracting your closing inventory. Suffice to know for this question, we don't have any adjustments to our purchases, so we can go ahead and we can start with our opening inventory. And our opening inventory in the question was $5,000. We're going to put in that $5,000 here. And to that, we are going to add our purchases that we calculated. And we calculated our purchases to be $107,900. That's our purchases, $107,900. So we are going to add our opening inventory and our purchases together, and that will give us a cost of goods available for sale. So the cost of the goods available for sale, and then we are going to now subtract our closing inventory. And the closing inventory in our question was $21,200. So subtract that, $21,200. So when we subtract our closing inventory, that is going to give us cost of goods sold that they gave us in the first place. So our cost of sales, which was given to us in the question, and you can see that that is correct. Our cost of sales, 91,700. That is what was given to us in the question. If you look here, 91,700. So what we're doing so far is correct. Cost of sales. So what we're going to do now is subtract our cost of sales from our sales figure. So 131,000 minus cost of sales, which is going to give us our gross profit of $39,300, and we would have calculated that previously by using our markup, and you would have seen that we've calculated it, so you know that we're on the right path, that we calculated that our gross profit was $39,300, and when we come back here in our income statement, that's the same figure. So we don't have any additional revenue, so please note that if you have additional revenue, you would add the additional revenue to your gross profit, which would give you a gross income, and then you will subtract your expenses. But we don't have any additional revenue, so we will go right ahead and subtract our expenses. So let's expenses, and our expenses were our administrative expense and our sales and distribution expense. So we look here in our bank account to see our expenses. Please note that if you had adjustments for accruals and prepayments. So let's say you had a prepaid revenue or an accrued revenue that you had to make adjustments for, you will pick up the adjusted figure and put as your expense. Similarly, you will pick up the adjusted figure. Once it's a revenue, you will pick up the adjusted figure and add it as your revenue. Now, if you had a prepaid expense or an accrued expense, and you had to make an adjustment for it, you will look for your adjusted figure that you would have calculated, and you will put the adjusted figure in your income statement as the expense for the period. You will not pick up the figure from the bank account or cash account and say, well, this is my expense, because you would have adjusted it. And then the other thing that you would need to do is always look back at your bank or cash account for any other additional expenses that you would have paid out during the period. So we didn't have any adjustments for our accruals and prepayments, so we can go right ahead with our administrative expenses of $13,700 from the bank account, and our sales and distribution expenses from the bank account again of $11,100. We also would have calculated an additional expense, which is called our depreciation for our fixed assets of $800. So we're going to include that as well. So we have depreciation, fixed assets of $800. That's a depreciation expense, not the asset, that's the depreciation. So we're going to total our expenses. So our total expenses are $25,600. $25,600 will be our total expenses. So then what we're going to do is that we're going to subtract our total expenses from our gross profit to give us a net profit. So $39,300 minus $25,600 gives us a net profit of $13,700. So that completes our income statement. So the next statement that we are going to be doing now will be the balance sheet. So we're going to complete this entire question. So we're going to do our balance sheet, and when we come back in the next video, that's what we will be doing. We will be doing our balance sheet, or our statement of financial position as a new term is, and that will bring our completion to our example question. And you can, as we go through, You can always look out for another video on another question with this particular topic of markup and margin. So when we come back, we will look at our balance sheet.